Welcome to the 5-Minute Disasters podcast from 5minutedisasters.com, where each week we uncover worldwide disasters in about 5 minutes. If you enjoy the show and would like to support us, why not consider buying us a coffee? Head on over to 5minutedisasters.com/coffee to see how. This is episode 13, The Wall Street Crash of 1929. The Wall Street Crash of 1929, also known as Black Tuesday, was a pivotal event in the history of global finance and marked the beginning of the Great Depression, a decade-long period of economic hardship that affected countries worldwide. The crash occurred on October 29, 1929, and was the result of a combination of factors, including speculative stock market behavior, economic imbalances, and underlying structural weaknesses in the US economy. The consequences of the crash were profound, leading to widespread unemployment, the collapse of businesses, and the erosion of public confidence in the financial system. The years leading up to the crash were marked by a period of rapid economic expansion in the United States, often referred to as the Roaring Twenties. After the devastation of World War I, the US economy surged, with new technological advancements, industrial growth, and consumer culture flourishing. The stock market became a symbol of this prosperity, with millions of Americans investing in shares, often using borrowed money to speculate on future profits. Stock prices soared, and the idea of getting rich quickly through investments became widespread. However, much of this economic growth was based on unstable foundations. Stock prices were increasingly inflated, often far beyond the actual value of the companies they represented. Many investors, both large and small, bought shares on margin, meaning they borrowed money from brokers to purchase stocks, betting that prices would continue to rise. This speculative bubble continued to grow throughout the 1920s, with little government oversight or regulation to curb the risks. By the autumn of 1929, signs of trouble in the economy began to emerge. Industrial production was slowing, consumer spending was decreasing, and farmers were struggling due to falling agricultural prices. Despite these warning signs, the stock market continued to rise until mid-October, when it began to show increasing volatility. On October 24, 1929, known as Black Thursday, panic selling set in as investors rushed to unload their shares, fearing that prices would collapse. Though a group of bankers intervened to stabilize the market temporarily, the underlying issues were too great to be resolved. The situation reached a tipping point on October 29, 1929, Black Tuesday, when stock prices plummeted. Over 16 million shares were traded that day, a record at the time, and the market lost billions of dollars in value. Investors who had bought shares on margin found themselves unable to repay their loans, leading to widespread bankruptcies. Banks, many of which had invested heavily in the stock market or loaned money to speculators, began to fail as well. The collapse of the stock market sent shockwaves throughout the financial system and marked the beginning of the most severe economic downturn in modern history. The impact of the Wall Street crash extended far beyond the financial markets. In the months and years that followed, unemployment in the United States skyrocketed, reaching as high as 25% by 1933. Businesses closed their doors, unable to maintain profitability, and banks collapsed, wiping out the savings of ordinary citizens. With wages plummeting and job opportunities scarce, millions of Americans were plunged into poverty. The effects of the crash were not confined to the US, as the global economy was interconnected through trade and finance. Countries in Europe and elsewhere also experienced severe economic contractions, with unemployment and poverty becoming widespread. The Wall Street crash also had significant political and social consequences. In the United States, the public lost faith in the government's ability to manage the economy, and President Herbert Hoover, who had taken office in 1929, became deeply unpopular. His policies of limited government intervention and reliance on voluntary cooperation between businesses and workers were seen as ineffective in the face of the growing crisis. In 1932, Franklin D. Roosevelt was elected president, promising a New Deal to revive the economy through extensive government intervention, social welfare programs, and reforms aimed at stabilizing the financial system. The legacy of the Wall Street crash of 1929 and the Great Depression it triggered is still felt today. The collapse of the stock market revealed the dangers of unchecked speculation and the need for government oversight of financial markets. In response, the US government introduced significant reforms, including the creation of the Securities and Exchange Commission, SEC, to regulate the stock market and the introduction of banking reforms to protect depositors. Additionally, the New Deal policies helped to establish the foundations of the modern welfare state and led to greater government involvement in the economy. The Wall Street crash also reshaped public attitudes towards financial risk and investment. In the decades that followed, many people remained wary of the stock market, and it took years for public confidence in the financial system to be restored. The lessons learned from the crash, particularly the dangers of excessive speculation and inadequate regulation, have continued to influence economic policy and financial regulation in the modern era. The Wall Street crash of 1929 was a watershed moment in the history of global finance, marking the end of a period of economic exuberance and the beginning of the Great Depression. The crash revealed the fragility of the global financial system and the devastating consequences of speculative bubbles. Its legacy endures in the regulatory frameworks that were put in place to prevent a recurrence of such a disaster and in the social and political changes that emerged in response to the widespread suffering it caused. The crash serves as a reminder of the need for vigilance and responsible governance in the management of economic and financial affairs. I hope you enjoyed that episode of the 5-Minute Disasters podcast from 5minutedisasters.com. If you did, don't forget to subscribe so you don't miss any future episodes. And while you're there, why not leave us a review? Also, please consider listening to our other 5-minute podcasts, which you can find at 5minuteproductions.com. Thanks for listening, and I'll see you next time.